Will the next Fed chair bring back easy money, or should investors brace for tighter conditions? Jeffrey Gundlach thinks Kevin Warsh won't open the floodgates, and that could reshape your portfolio decisions. Here's the context. Markets have been betting on faster rate cuts as Fed leadership shifts. But Gundlach, a closely watched bond investor, says Warsh is unlikely to run an overly accommodative policy. That points to vigilant inflation control instead of a quick pivot, a big signal for pricing stocks, bonds, ETFs, and even crypto. Why does that matter now? Inflation once peaked at 9.1% in 2022, and the Fed hiked about 525 basis points to cool it. Those numbers still anchor expectations. A chair who remembers the 2006-2011 crisis years, as Warsh does, tends to prize financial stability and a firm hand on liquidity. If policy stays vigilant, the odds of a runaway term premium, those extra points in long-term yields, can fall. That can help anchor long-run borrowing costs. But it also means less chance of rapid easing. Rate-sensitive corners of the market may feel more pressure. Think long-duration bonds, high-growth equities with cash flows far in the future, and some crypto proxies that trade like high-beta risk assets. Volatility can rise when hopes for quick cuts fade. Investors should also recalibrate earnings assumptions. A steadier, data-driven path with lower tolerance for above-target inflation can keep financial conditions tighter than bullish scenarios assumed. That tends to favor quality balance sheets, durable cash flows, and reasonable valuations over speculative growth tied to cheap capital. So, what's practical right now? Review duration risk in your bond allocation and stress test against stickier policy rates. In equities, consider whether your mix leans too heavily on long-duration growth and whether adding quality or value helps balance rate sensitivity. For ETFs, look under the hood for factor tilts and interest rate exposure. In crypto and other high-volatility assets, assume that liquidity tailwinds may be choppier and size positions with risk controls. Keep an eye on the data that will guide policy, inflation trends, labor market strength, and how forward curves and real yields evolve. Bottom line, a Warsh-led Fed, as Gundlach frames it, likely means firmer inflation-fighting messaging and fewer odds of quick cuts. Plan for steadier, not looser. Align portfolios with quality, resilience, and disciplined risk management. Read the full article at finlitica.com.